Okay, everyone, I want to make a video about a particular topic related to trading. I've gotten an email or two over time where someone asked the question, I had a stop loss at a particular price and I got stopped out, but it wasn't at the price that I designated. What's going on? Is the question. All right. A couple of things that you need to understand about stop losses first. The first thing is that when a stop loss executes, it doesn't necessarily execute at the price that is desired. It executes at the price that is available at the time that the stop loss is triggered. So let's use, for example, here we have Amazon on the screen. I'm going to maximize this so you can see it. So you have Amazon on the screen. Over here on the right, you have a ask price of 137.70. And over here on the left, you have a bid price that says 137.68. Now let's suppose that you had a stop loss for 137.69, which would be halfway in between the bid and the ask. Now if that's where your stop loss was, and someone sold, and they sold at a price that is below your stop loss would then be executed not at the price that you put the stop loss at, but at the next available bid to sell. So right now you can see the bid-ask spread for just a second was 60. It was 137.60 for a moment at 137.69. Right now there's a 3-cent bid-ask spread between 137.66 and 137.69. So if the price 137.68 traded, right? I'm sorry, if the price 137.66 traded, then your stop loss will get executed at 137.66 or lower, even if the stop loss was placed at 137.67 or 137.68. It wouldn't matter because neither of those prices were tradable at the time that 137.66 traded. Now it's very important to understand this because when we look at the time in sales, you don't always see that every price traded. For example, here we have 137. Let me make this larger. We have 137.68 right here, and the price preceding it is 137.66. Notice that 67 is missing because it never traded. Right here we have 137.65 and 137.68. Notice that there's prices in between, namely 137.66 and 137.67. They're missing. A stop loss is never guaranteed to be executed at the exact price that you place it. The way that a stop loss triggers is if the price that your stop loss is at, or a price further away, in other words, if you have a sell stop, if the sell stop price or any price below it actually trades, then the stop loss is triggered and it will execute at whatever is the current available bid price. So if the current bid is less than the price that you want to sell at, is less than the price that your stop loss was at, it doesn't matter. You're still going to get executed at that price, not the price that your stop loss is at, unless that price is currently available at the time that the stop loss is triggered. So again, just because you place a stop, like you look right here, the price 137.68 has not traded. We went 137.69 immediately down to 137.66, then back up to 137.68, and only now do we see one trade at 137.68. But your stop loss does not wait for that price. If it were to wait for that price, that would be a stop limit. A stop limit is different than a stop loss. A stop loss triggers a market order to exit you out of a trade once the price that you placed the stop loss at is either reached or surpassed, or the market goes beyond it. If the market goes past your stop loss price, then you still are going to have to get filled, but you won't get filled at the stop loss that you want. All right, so guys, always keep this in mind. You're going to see this happen for stocks that are wider in their bid-ask spread. For example, like Amazon, or if I look at Coinbase, Here we have 79.15 at 79.38, which means that if you had a stop loss at 79.20, 79.20 wouldn't trade because there is no bid at 79.20. The next bid is at 79.15. So if someone were to sell immediately at market and hit 79.15, that's exactly the price point that your stop loss will get triggered to trade at, even though the stop loss itself was at 39.20. Okay, if I look at another example, here's Roku. Roku has 82.60 at the bid, 82.70 at the ask, right? So again, if you had a stop loss at 82.65, right? If that were your stop loss, you could have it there, but as the moment 82.60 trades, your stop loss will be triggered because that price is equal to or less than your stop loss price. So you immediately get triggered to sell, but you wouldn't sell at 82.65, you would sell at 82.60. Likewise, if you were doing the opposite, if you short sold the stock and then you put a stop loss, let's say at, I don't know, let's say you put the stop loss at some price like 82, whatever, you put the stop loss above. Well, whatever price gets hit first, in other words, if your stop loss were at 82.65, right? If your stop loss were at 82.65, and let's say the last price they traded was 82.60, then if the next price that trades is 82.70, 82.65 never traded. You would get filled at 82.70, not 82.65, because your stop loss cannot trigger unless the price that you put in actually, if the price that you put in, either it trades or a price, in this case for a buy stop, if a price that's higher than that trades, then you also will get executed, but you won't get executed at 82.65. You're going to get executed at 82.70 in this case, or potentially higher if that price were not available right away. Okay, so any stocks that have wider bid-ask spreads, this is going to happen a lot. Stocks that have tighter bid-ask spreads, you may not see it happen that often. But if you're looking at stocks like Roku, Amgen, Coinbase, stuff like that, or even Amazon, after hours at least, but during the regular session, certain stocks have pretty wide bid-ask spreads. So during the regular session, these spreads will be a lot tighter, but they're not going to be so tight that you won't see this happen. And especially at times when there's significant volatility, a lot of times spreads change. They widen quickly because there's lots of competition to quote bids and offers. It's not like people are waiting for you to give you the best price available. They're putting out whatever bid or offer they think is best for them. So if you happen at the time to be in a trade when the market's really moving, there's a good chance you may get that difference between where you wanted to get out or even get in if it was a market order where you actually end up getting executed. Only a limit order guarantees that you get filled at the price you want or better, but a stop loss does not. Okay, and the difference between the price of the stop and the price you actually get filled at is known as slippage, and slippage is real. So if anytime you see that you get executed at a trade, to get out of a trade and you think something is wrong, immediately look at the bid-ask spread, look at the time and sales history especially. It will tell you what trades happen. If you don't see that your price traded at all in the time and sales at the time that you were looking to get filled, then you know right away what went wrong. Okay? Hopefully that helps, folks. Take care.